All right, Brian here from NetPicks. Just wanted to talk to you about a debit spread trade with a profit of $1,793.38. And I wanted to walk you through how it worked. Like I said, I'm Coach Brian from NetPicks. And in early February, I was watching the news. There were, if you remember back then, there were ICE protests. The government was shutting down. The Epstein files were just released. There was a Middle East buildup, a military buildup in the Middle East. Trump was, tweeting all the time. You had the Gaza war going on and the Winter Olympics. And I was sensing some weakness in the market. I don't know what it was. It was a gut feeling. I wish I could tell you or point to a formula or a chart or something like that. It was just a gut feeling that I was expecting some weakness in the market. And so I decided to take action and I put on a debit spread. And I spent $4,163.31 to put on this debit spread. And I'm going to walk you through what this was and how it was. So here's the confirmation. Back on February 2nd, I bought to open a Diamond, DIA, April 17 put at the 480 level strike. And I sold the Diamond 417, 440 strike. That creates a debit spread. So it's money out of my pocket. So on the top one, I bought it. It cost me $6,300. And I sold the lower one for $2,100. So why this trade? Well, the diamonds represent a really broad market. It's an ETF that holds 30 stocks. They're the biggest and best. They track the Dow Jones Industrial Average, and it's a great way to get exposure to a bunch of different industries. And it also limits your single stock exposure. As you can see from the list on the left, there are not a whole lot of massive holdings. This is not like the QQQs where the top 10 companies represent, 50 some percent of the assets or whatnot, right? You're going to have a nice mix, and it's also going to be a mix across sectors. It's financial, it's industrial, technological, right? Healthcare, all those good things. And, it's a large value stock, and the asset size is huge, $44 billion in assets. So it's the perfect time to trade. And if we did catch the weakness that I was expecting, the Diamond ETF should trend lower. Now that's the key word, should. So now, why did I pick the options that I picked? So the first thing is remember, I was making this trade in early February, and I wanted to give myself time for this to settle out. So I actually bought the options and chose the options that expired in April, mid-April to be exact. I figured that would give me enough time for this to take place, and I'd have a lot of time value inside of the options that I could play with and watch, right? And with the debit spread, the reason why I picked the debit spread was I was expecting a pullback, but not a recession. I was looking for a 5-7% pullback. I'm not expecting a massive correction. I'm not expecting a 70% drop in the markets, right? So that's why I chose the debit spread. And the debit spread is a lot better than a straight put call type of option, right? So in this case, if I had just bought the straight put, it would have cost me $6,300. By adding on the extra leg and selling the lower strike put, it cut my costs by 30%. It limited my cash outlay. So, here's what the trade looked like in my account. Luckily, the service I use has a put spread. I went in and I bought 10 contracts. Now, you could have done this with one. I chose 10. I picked 10. You can see the pricing. I did the midpoint and I got filled. And then here's what happened, right? So, over the next few days, you see where I got in at this first arrow on the left, and the market really just kind of drifted sideways. So not ideal for what I was expecting to trend lower. And then what ended up happening was we got this little sell-off. Now, what happened here? This was the initial attacks on Iran by the United States. Trump was tweeting, military, was firing rockets and blowing stuff up, and the market did trend a little bit lower. We tested that 480 level, as you can see right in here, but we bounced off of it and moved higher. And that really had me worried that all the negative news, and I didn't get the move that I expected. So the day the market dipped was where I sold my options contract. I sold the entire debit spread. So I sold to close the first diamonds, the 480, and I collected $8,300, and I bought to cover the April 17th 440 diamonds for $2,300. Now, I was lucky the market had dipped a little bit and those options values had gone up. And obviously, I did this basically a month later, leaving myself only a handful of weeks until the expiration. So that's another reason why I pulled the trigger on exiting. I thought the move was going to happen a lot lower. So I exited the trades. I put another $5,900.56. Sorry, $5,956.69 into my account. And if you remember, I originally spent $4,100. So my profit on the trade was $1,793.38. That's a 43% ROI that helped me make my Jeep payment personally. It was a great trade, right? You never got to be upset. You never want to be upset when you're taking a profit. But here's the real truth. I missed out on a bigger trend. I exited just too early. The market kept trending lower on the Iran war news, and you saw this whole market shift lower. Had I held on another week or two, I would have seen even bigger gains in the options. But altogether, I'm happy because of my profit and my ROI. So that's what I wanted to share with you on how to put on these trades using a debit spread trade, the expectations that I had, and the results. So hopefully you find this interesting. If you want to learn how to put on more trades like this or use other options to profit, check out the free report that we have in the link below. Click the link below. You'll find the free report. Download that. And I trust me, you'll learn a ton. So have a great day and keep trading.